Stop watching the ticker. The war isn't happening on the screen. While the financial media is obsessing over interest rates and stock valuations, the real world just shifted gears. In the last few days, the scramble for physical silver and critical natural resources went from background noise to the main event. This isn't happening in the headlines. It is happening in the dark. It is happening where supply chains break, where ships don't sail, where mines don't ramp up overnight, and where governments suddenly remember the one terrifying truth of economics that they forgot. For 30 years, you cannot print a barrel of oil, you cannot print a ton of copper, and you certainly cannot print an ounce of silver. Here is the uncomfortable truth that the establishment refuses to admit. A multipolar world is not coming. It is already here. And the moment that reality hits, the fight isn't over growth anymore. It is over control. It is a kinetic struggle for the stuff that makes modern life work: energy, minerals, and the monetary metals that anchor them. I want you to burn this phrase into your mind because it is going to define the rest of 2026. You can't sanction geology. You can sanction a bank. You can sanction a person. You can sanction a shipping company. But if the world needs the metal, and the metal is in the ground of a rival nation, someone will find a way to trade for it. The Rock does not care about your politics. The Rock does not care about the SWIFT system. The Rock only cares about who has the physical capacity to dig it up and the military capacity to ship it home. We are watching the collapse of the paper sanction era. Every time the West tries to secure a resource region by force or financial pressure, it accelerates the other side's motivation to build an alternative. And those alternatives almost always involve moving away from the dollar. Why is the United States suddenly acting so aggressively around resource-rich regions? Why are we seeing sudden tension in the Arctic? Why is the Middle East pipeline map being redrawn? Because the empire of debt is realizing it is running out of collateral. For 40 years, we ran the world on credit. We exported dollars and imported real wealth. It was a great deal until the rest of the world stopped wanting the credit. Now, the bill is due, and when your balance sheet is stretched, you can't afford to be cut off from critical inputs. You push, you threaten, you negotiate aggressively, because the alternative is a slow, grinding decline in industrial capability and military readiness. But while the politicians argue over maps and borders, the real revolution is happening in the plumbing of the global financial system, a technological bypass called Project mBridge that is about to render the US dollar's weaponization obsolete and turn silver into the ultimate strategic asset. Let's start with the mechanism that broke the world. For the last 80 years, the United States held a superpower that was more effective than any nuclear arsenal. It wasn't the Marines, it wasn't the Air Force, it was SWIFT, the Society for Worldwide Interbank Financial Telecommunication. Think of SWIFT as the Gmail of money. If you wanted to send money from France to Japan or from Brazil to China, your message had to pass through this Western-controlled server. And because almost all global trade, oil, wheat, metals, was priced in dollars, every transaction had to clear through a U.S. correspondent bank in New York. This gave Washington the power of the light switch. If a country misbehaved, if a regime stepped out of line, the U.S. Treasury could simply flip the switch. No dollars, no trade, no food, no medicine. It was the ultimate weapon. It worked perfectly. Until we used it too much. They tell you that sanctions isolate the enemy. The reality is, sanctions isolate the issuer. When the West decided to freeze the reserves of a G20 nation, seizing $300 billion of sovereign assets with the stroke of a pen, it sent a shockwave through every capital city in the global South. From Riyadh to Brasilia, from Jakarta to Pretoria, the message was received loud and clear. If we keep our money in their banks, it isn't our money. It's just a permission slip. This triggered the Sanction Paradox. By weaponizing the dollar to punish our enemies, we forced our enemies to build a shield that makes the weapon useless. And that shield has a name. You won't hear about this on the nightly news. You won't see it on the front page of the Wall Street Journal until it is too late. It is called Project mBridge. This isn't a conspiracy theory. In the old system, SWIFT, if Thailand wanted to buy oil from the UAE, they had to convert Thai baht to US dollars, send the dollars through New York, and then convert them to UAE dirhams. It was slow, it was expensive, and it was subject to US approval. Under Project mBridge, that transaction happens on a shared digital ledger. Thailand sends baht. The UAE receives dirhams. The transaction is instant. The cost is zero. And most importantly, the US dollar is not involved. There's no New York correspondent bank. There's no swift message to intercept. There's no light switch to flip. This is the technological bypass operation. It is the death of the dollar's network effect. Once this system scales, and the Saudis just joined the project as a full participant, the demand for petrodollars collapses. Why hold dollars to buy oil if you can buy oil directly with your own currency? And when the demand for dollars drops, the value of the dollar drops. When the value of the dollar drops, the price of real assets, gold, silver, oil, explodes in dollar terms. We are not looking at a recession. We are looking at a monetary migration. The world is moving from a permission-based system, dollars, to a bearer asset system, gold and commodities. Now, let's connect this macro financial war to the specific metal in your safe. Why silver? Why not copper? Why not lithium? Because silver is unique in the periodic table. It is the dual-use dilemma. Silver is the only element that is both a monetary metal, trusted as wealth for 5,000 years, and a strategic industrial metal, essential for the digital age. You cannot build a Tomahawk missile without silver. You cannot build a solar panel without silver. You cannot build an EV, a server farm, or a 5G tower without silver. Silver is the lubricant of the 21st century. Without it, the engine seizes. In a peacetime global economy, this isn't a problem. You just buy it from Mexico or Peru. But we are no longer in a peacetime economy. We are in a fragmented economy. And here is where the choke point emerges. A huge percentage of the world's silver refining and processing happens in China. Just like with rare earths, the West allowed the supply chain to drift east because it was cheaper. We exported the pollution and the labor cost. We thought we were smart. But now, in a resource war, we realize we exported our sovereignty. If the hot war escalates, if sanctions fly and trade routes close, China doesn't have to fire a shot. They just have to stop exporting refined silver paste. If they do that, the Western solar industry dies overnight. The Western electronics industry enters a coma. This is why strategic nations are hoarding. We are seeing import data from India, from Turkey, from China itself. Massive record-breaking tons of silver being pulled off the London and New York markets. They aren't making jewelry. They are building strategic stockpiles. They know that in the next phase of this conflict, he who has the metal makes the rules. Let's move from the financial, mBridge, and the industrial, silver, to the kinetic. Let's talk about geography. Because in a resource war, maps matter more than charts. I want you to visualize a narrow strip of water in Southeast Asia called the Strait of Malacca. It connects the Indian Ocean to the Pacific Ocean. It is 500 miles long, and at its narrowest point, it is only 1.7 miles wide. Roughly 25% of all global trade passes through this tiny bottleneck. Most of the oil that fuels China passes through here. Most of the manufactured goods that stock Walmart shelves pass through here. This is the jugular vein of the global economy. And right now, it is the most dangerous place on Earth. Why? Because if a conflict breaks out over Taiwan or over the South China Sea, this strait becomes a kill zone. If the U.S. Navy blockades the strait to starve China of energy, or if China mines the strait to deny access to the West, the global supply chain doesn't just slow down, it snaps. Ships don't sail. Insurance rates go to infinity. And suddenly the paper price of commodities becomes irrelevant because you cannot get physical delivery. They tell you the supply chain is healing. The reality is the supply chain is one wrong move away from cardiac arrest. This kinetic risk is why the spot price on your screen is a lie. The spot price assumes a frictionless world where a bar of silver in London can be in Shanghai tomorrow. In a Malacca scenario, that assumption dies. The price of silver in Shanghai, where it is needed, would disconnect completely from the price in New York, where it is traded. We would see regional pricing. Silver in the East could be $200. Silver in the West could be $50, but you couldn't get it. This is the ultimate argument for physical possession. If you hold a paper contract, you're betting that the Strait of Malacca stays open. If you hold physical metal in your own jurisdiction, you are immune to the map, you are your own central bank, and you are your own supply chain. Now let's move from the geopolitics to the mathematics. Because even if you ignore the war, and even if you ignore the supply chains, the sheer financial valuation gap is screaming at you. We need to look at the S&P 500 to silver ratio. Most investors look at the price of silver in dollars. That is a mistake. The dollar is a melting ice cube. Measuring your wealth in inches with a shrinking ruler is useless. Instead, we measure assets against assets. How many ounces of silver does it take to buy one share of the S&P 500? Historically, this ratio acts like a giant pendulum. It swings from peak paper, where everyone loves stocks and hates commodities, to peak real assets, where everyone flees stocks and hoards commodities. In 2000, during the dot-com bubble, we were at peak paper. In 2011, during the silver squeeze, the pendulum swung back. Right now, we are stretching the elastic band to the breaking point. We are at historic extremes where paper assets are priced for perfection and hard assets are priced for bankruptcy. They tell you that stocks always go up in the long run. The reality is, stocks go nowhere in real terms during a commodity supercycle. Look at the 1970s. The Dow Jones went sideways for a decade. But if you held gold or silver, you made a fortune. We are entering that cycle again. The rotation has begun. Smart capital, the smart money, inside the family offices and sovereign wealth funds, is quietly selling the overvalued tech stocks and rotating into the undervalued resource sector. They are selling the AI hype to buy the copper reality. They are selling the software margin to buy the silver inventory. Why? Because they know the ratio must revert to the mean, and for that ratio to normalize, one of two things must happen. The S&P 500 crashes by 50%, silver triples in price, or most likely both happen at the same time. This isn't just a trade, this is a generational wealth transfer. It is the moment where the people holding the paper bag get wiped out and the people holding the physical asset become the new banks. This brings us to the final psychological shift you need to make. For the last 15 years, we lived in a zero interest rate policy, ZERP world. In that world, money was free, risk was rewarded, and the only goal was return on capital. You chased yield, you chased growth. You asked, how can I make 20% this year? But in a resource war, in a world of broken supply chains, kinetic conflict, and monetary resets, the goal changes. The goal is no longer return on capital. The goal is return of capital. Can you get your money back? If the grid goes down, do you own the asset? If the bank declares a bail-in, is your wealth segregated? If the Strait of Malacca closes, is your portfolio dependent on just-in-time delivery? The era of optimization is over. The era of resilience has begun. This is why the central banks are buying gold at a record pace. They aren't trying to make a profit. They are trying to survive the transition. They are de-risking. And if the Central Bank of China, the Central Bank of Poland, and the Central Bank of Singapore are de-risking, why are you leveraged long on the NASDAQ? Silver is the ultimate return of capital asset. It has no counterparty risk. It cannot go bankrupt. It cannot be hacked. It does not rely on a CEO, a board of directors, or a quarterly earnings report. It simply is. When the dust settles on this transition, whether it takes 2 years or 10, the people who own the pain mignon, the primary collateral, gold and silver, will be the ones who have the purchasing power to pick up the pieces of the shattered paper economy for pennies on the dollar. This is the mindset of the dynastic wealth. They don't worry about next week's dip. They worry about the next decade's regime change. And right now, the regime is changing from paper to rock. We have arrived at the conclusion. We have covered the Sanction Paradox that broke the dollar's monopoly. We have mapped the silver choke point that threatens the digital economy. We have visualized the Strait of Malacca, where a single kinetic event could sever the global supply chain. And we have done the math on the S&P to silver ratio, proving that paper assets are historically expensive while real assets are historically cheap. The picture is clear. We are not just watching a bull market. We are watching a civilizational pivot. We are moving from a world built on trust, credit, treaties, just-in-time delivery, to a world built on verification, possession, stockpiles, domestic production. In this new world, the old rules of investing will get you killed. The 60-40 portfolio of stocks and bonds worked when inflation was dead and peace was guaranteed. That world is gone. It is not coming back. The new portfolio is collateral. It is energy. It is food. And it is the monetary metals that command them. So, what do? How do you position yourself before the masses realize the music has stopped? Step 1, get off the grid. I don't mean move to a cabin in the woods. I mean move your wealth off the digital grid. If your silver exposure is purely in ETFs or unallocated accounts, you're betting on the SWIFT system. You're betting that the counterparties remain solvent. You need physical possession. If you can't hold it, you don't own it. In a resource war, possession is not 9/10 of the law, it is 10/10. Step 2. Ignore the paper smashing. They will try to scare you out. They will use the futures market to dump paper contracts at 3 a.m. to paint the chart red. Do not fall for the price trap. Look at the value. When they smash the price, ask yourself, did the Strait of Malacca get wider? Did the mines find more silver? Did the dollar get stronger? If the answer is no, then the price drop is a gift. It is a subsidy from the paper manipulators to the physical accumulators. Take the subsidy. Step 3, watch the ratio, not the nominal price. Stop looking at $30 or $50 or $100. Look at the ratio. When 1 ounce of silver buys you a significant fraction of the S&P 500, then you can think about selling. Until then, you are simply exchanging a dying currency for a living asset. I want to leave you with this. There's an old saying in military strategy: amateurs talk strategy, professionals talk logistics. For the last 40 years, the financial world has been run by amateurs talking about yield, growth, and PE ratios. They forgot about logistics. They forgot that you need actual fuel to power the grid and actual silver to build the chips. Now, the professionals, the generals, the emperors, the state planners are taking over. They are focused on logistics. They are securing the atoms. While the amateurs are fighting over the last few crumbs of the paper economy, the professionals are buying the mine. Don't be an amateur. Think like a logistician. Secure your supply. The mainstream financial media will keep telling you to buy the dip in tech stocks until the very moment the lights go out. They are designed to keep you inside the burning building. We are building the fire exit. If you want to navigate this transition with your eyes open, if you want to stand with the few who understand that the map is not the territory, then you know what to do. Join us. Subscribe and turn on notifications. Because the next time I speak to you, the Strait of Malacca might be closed, and the price of admission will be infinite. Stay safe. Watch the choke points. And I'll see you on the other side.